Hey, and welcome to today's webinar. We're calling this an Inverse series, and it's hosted by myself, Jamie Harford. I'm a formerly VC-funded founder, and I'm the owner of Inverse Funding, and we help prepare companies for fundraising rounds. Welcoming today, we've got Damien Burke, who's a highly experienced and skilled senior risk professional with a proven track record in delivering effective risk strategies in the retail, commercial, and wealth management banking sectors. With over 2 decades of experience, Damien has held various leadership roles in top financial institutions such as currently Custom Credit, previously Foremost, Parker Fitzgerald, TSB, Deloitte, and Barclays Wealth Management. As mentioned, Damien is now the founder of Custom Credit, which we'll get into in a little moment. The idea today is just to get to know Damien and the business and what makes them both tick. But really, we're looking to get a little bit further under the skin. So great to meet you, Damien. It would be good to start, obviously, coming from such a great professional track record. I'm sure your family thought you were mental when you said you were going to leave. So do you want to share a little bit about the background and why we're sitting here today, I guess?
Yeah, no, you're not far off in terms of the general reaction. So I often describe it as a sort of a decision 20 odd years in the making. I had a really kind of interesting and broad career within financial services. And I think that kind of really came about because I didn't really expect to have a career in financial services. I was at university doing an engineering degree, and this opportunity came up at TSB, as it was at the time, as a debt collector. And probably about a month after I joined, they announced that they were merging with Lloyds Banking Group to become Lloyds TSB. But I spent, some weirdly happy times in debt collections. I started to understand, kind of that kind of customer-facing piece really, really well. And actually, even though it's a sort of a difficult environment and you're having difficult conversations with customers, how you could help them without actually detracting from Lloyds Bank Group's or Lloyds TSB's overall objectives, i.e. I was always one of the sort of top performers. And I guess, given that I never really expected to sort of be in that career, I was much more open to moving around. And as a result, I did end up in lots and lots of different roles, kind of touching every sort of side of banking you could imagine in terms of new acquisitions, portfolio management, policy and regulation, data, kind of assurance type work. So for a while I was effectively a troubleshooter going around and doing specific sort of reviews of different areas and coming up with what's not working, great, but also how do we fix it? So I ended up actually, gathering a much broader, but also quite deep knowledge of lots of areas of banking, which really I feel a lot of my peers don't have, purely because they've typically come in as a graduate, and then almost have their own path determined for them. So yes, it's something that I really value and something I want to take into this. I guess that kind of gives a bit of a background, but why did I end up making the decision to kind of move away from that? Well, I spent broadly 10-11 years with Lloyds, and then broadly sort of 10-11 years with in some form of consultancy, and the consultancy gave me lots of great experiences in terms of sort of big change management projects. I had developed a methodology for applying a new accounting standard, so something called IFRS 9. which I believe I was probably the first in the UK to come up with something that was effectively approved by one of the big audit firms. So I was able to kind of roll that out across the industry, and all the time I was doing that, I felt like I was really making a difference to the industry, and along the way also helping banks with their IRB applications as well for capital purposes. And I did feel very valued, and I felt that the work I was doing was valuable. And I guess when something like COVID hits, you start really kind of scratch under the surface of, well, how do you feel about what you're doing now? And I guess the conclusion I came up with is, because I'd maybe moved away from some of that sort of work deliberately, because I kind of wanted to get back to some more kind of customer, not so much customer facing roles, but certainly something that was more kind of customer focused. I started to realise that that maybe that customer focus isn't always that prevalent in the industry. Yeah, I guess the first person who was kind of quite surprised that I was going to make this change was my old boss, because I had been kind of moaning about the situation over email, about, you know, some particular examples, you know, he kind of made the sort of throwaway comment via email that, oh, I wish somebody would do something different. And I kind of phoned him up the next day and said, I'm leaving and I'm going to go and do something different. So yeah, probably not the response he was looking for. But
it makes a lot of sense. So that kind of leaves us to sort of where we are today, or, you know, a couple of years ago.
Yeah.
So obviously, you know, the big thing that you pointed to was there you've got, you know, quite a diverse background within financial services. What was that real problem then? What did you take all of the 22 combined plus years and go, okay, this is the problem I want to spend my time on? What was that?
Yeah, so I guess the real problem is that banks and lenders, in my opinion, are not customer centric enough, right? They aren't customer focused, and really they don't have to be, because the market is such that the demand for credit, the demand for other financial products is so high, it really is a seller's market. And you know, you only have to look at banks and lenders across the board who have nothing remarkable about their products, and they make significant profits. And my own experience of sort of viewing that was, typically they don't have to do that much to do it either. You know, there's been lots of circumstances where I would make a suggestion which, yes, required a little bit of upfront effort, but ultimately would give the customer a better experience and would be more profitable for the lender. And there was a real reluctance to do it. Now, that to me is the kind of core problem. I guess where that problem comes from is a little bit more tricky to
and where does the reluctance come from to actually change within the industry?
So I think the first thing is, you know, a lot of people in financial services, weirdly, could say weirdly, could say not, are risk adverse. So, you know, I've heard multiple decision makers in the industry say, I'd rather be wrong with everybody else than right on my own, on the basis that if you're doing the same thing as everybody else, it's hard for you to be singled out and criticised for doing something wrong. I think possibly the other reason is that even if you do get something wrong, often it's picked up quite a way down the line. So if you happened to be the bad actor, you know, the likelihood of you still being in role when you get picked up and the firm gets censured by the FCA or the PRA is probably quite limited. So it's all about kind of short-termism. But I think also the kind of bigger kind of causal problem for me is that, like I said earlier, a lot of people in my position, peers of mine, decision makers within financial services, haven't come through a route that enables them to understand what their customers want and need. So, most senior decision makers nowadays, or the people that would be senior decision makers in a few years' time, would come through a very kind of focused. They'll have come from university. They'll have done probably statistics, or they'll have done economics, or something else that is kind of quite maths, technical type heavy. They'll probably have a first class honours degree. They might have a master's. They might have a PhD. And typically, they would not be users of the products that they are developing. And probably, they don't know that many people that would either. It's a very particular socioeconomic group that are decision makers within financial services. So, I think the first problem, what we said earlier, is there are some firms that, in my opinion, don't really have the customer's best interests at heart, and lots of the kind of legal documentation and all that sort of stuff kind of means that if the customer gets it wrong, it's really going to be the customer's problem rather than the financial services problem, firm's problem. But then, even if you really, really wanted to do good in the industry, if your heart was in the right place, your lack of understanding of your customer base means that even when you try and do the right thing, you're likely to get it wrong. So we've really kind of come up with ways to focus ourselves on that. So the first thing is that we aim to be the most customer-centric fintech in the UK. Now, that's obviously going to be really difficult.
It's a broad statement, yeah.
Really broad, really difficult to measure whether you've got there or not. But to a degree, that's almost deliberate, right? What I don't want to do is set a target that is really easily achievable, right? This target should keep us on our toes. We should always be asking ourselves the question, are we the most customer-centric fintech in the UK? And probably the answer will always be, not sure, right? So that's going to make us say, well, what else can we do, right? Rather than just sitting back and saying, yeah, we've done it, we've achieved it, right? So
let's backpedal a little bit then. So we've obviously understood the problem and sort of where this has come from. What we haven't really done is introduce custom credit properly. So let's have an overview of the business, including a brief summary of a product and solution, product and service, and obviously the target market for it.
Yeah. Okay. Sure. So the name custom credit will give you a bit of a clue, right? So what we're ultimately trying to do is we are trying to customize loans for individual customers, right? Now, you might ask, well, doesn't everybody do that? Short answer is no, they don't, right? So if you take a typical application process, lots of lenders will rely on only a credit score, which is provided by a CRA, for their credit assessment. There might be a few little kind of identifiers individually or elements individually that they value as well, but very, very broadly based on a score. And, knowing what I know about the industry, those scores are very good, but they're not great in terms of understanding individual circumstances, right? So, they put particular weighting on things which are typically indicative of good or bad risk. But that doesn't necessarily mean that a customer with one of those characteristics is a good or a bad risk, right? Then for affordability, the vast majority of lenders rely on ONS data for expenditure and disposable income data from the credit reference agencies, again, for the income data, right? Now, if you think about ONS and CRA as data sources, by definition, they are averages, right? And by definition, or by production, they are almost always out of date. You know, so if you think about the process, even if I'm a lender and I send some experience about my customer to the CRA, they've then got to run that as a process and then give it back to you, right? And you'd think probably in the days of fast data transfer and all that sort of stuff that it's kind of pretty much instantaneous, but often it's not. It's often at least 2 months out of date. And actually what we saw in COVID was some lenders who were relying on that data kind of being upset that it was out of date and not really doing the job for them, but then themselves hadn't actually sent that data. So they'd sent files from the previous month, effectively, because they were too busy to do anything else with it.
That is just ridiculous.
Yeah, but not uncommon. So if you think about all of those things, at the very, very start of the process, you're using lots of averages to come up with effectively a yes or a no answer. And it often does boil down to that yes or no answer, because they are effectively saying yes or no on a set amount, and they're effectively saying yes or no on a fixed interest rate. So, you know, if a customer comes in and is super high risk, and a customer that comes in that's super low risk, for a lot of lenders, they will get the same price because they don't do risk-based pricing. So, you know, at every step of the way with a traditional loan, they are very fixed and they are very predetermined, even to the point where, you know, if you went on a lender's website today and tried to get a loan which was for 37 months, you'd probably find it difficult. You know, you get one for 36, definitely get one for 42 or 48, but for 37, because it's just out of the realms of, you know, standardised or whatever. So
do you sit in this situation then? Do you sell the products, or do you to the consumers, or do you sell the product? You know, your loaning and credit to the actual lenders. Where do you sit in that ecosystem?
No, so we are very much a fintech focused on consumer lending. You know, it's not to say that in our pipeline that we wouldn't open up our sort of technology and be able to kind of resell our approach, because part of the reason we're doing this is because we want to change the industry. We want to make it more consumer focused. So there may well be a path in our future that says, well, the best way to do that is to, you know, get other lenders to use it, and obviously there's a value to us for doing that as well. But very much our focus at the moment is direct to the consumer. So the consumer would go on an aggregator website, you know, somebody like Money Supermarket, Compare the Market, that sort of thing. And, you know, if they meet our criteria, we'll be one of the options, and they can go through that process. Or they can go direct to our website, so www.customcredit.co.uk, and they can apply for a loan directly online. And that process is completely managed with our systems, our architecture. So we'll go off and do the credit scoring and everything else. And our credit decisioning is all proprietary, as is our affordability assessment. And we're pretty certain that nobody does the affordability assessment in the way that we do, because that was part of our application process with the FCA, and it was obviously something that was very interesting to them because they hadn't seen it before. So we had to, you know, effectively make sure that we could still meet all the kind of regulatory hurdles for that. So going on back to how we do things differently, then I'll kind of explain what the status quo is. What we do is, yes, we'll take the ONS data, the CRA data, and all those things, and we'll consider them as part of the application process. But for every application initially, we will also take open banking data. So it is a requirement of ours that you supply access to your bank account at application. So I don't know if you know much about open banking data, but effectively it's a part of the PSD2 changes, and effectively what it means is that a customer can go in and say, yes, I would like custom credit to have access to my data. Now, we don't access it directly, we've got to do it through a third party. That's a different regulatory license, and we effectively then agree with that third party what sort of standard of data we're going to get, how we're going to use it, right? So there are lenders out there that say they use open banking data, and to a degree they do, but open banking data is effectively a spectrum of what you can have. So at our end of the spectrum, we take at least 12 months of data where it's available, and we take the individual transactional data, right? So we do have categorization provided by our third party, but we don't necessarily just rely on that. We provide our own overlay on it as well. Other ends of the spectrum, lenders could just say, take the last 2 or 3 months data, and they could only effectively rely on the outcome, so that there are data providers out there that would say, look, we'll do the affordability assessment for you effectively. Now, the reason that we take that individual transactional data, so the last 12 months of every single day, here's all of your transactions and here's your money going in and money out, is because we use that as part of the scoring process to get a different rate, and we use it as part of the affordability assessment. And this is really, really what our USP is about. We know that when other lenders perform affordability assessments to get that yes/no answer, because of those averages that we talked about before, there will always be cases, for example, somebody who gets bonuses where that bonus would be, say, knocked out of the application assessment, and effectively they would be declined for a loan that they can afford, because it will look like they can't afford it. And vice versa, there will always be circumstances, typical example I use is somebody who gets regular overtime, where they'll drop out the lower amounts because it's not a good average, it's an anomaly, they would see it as, and effectively that customer would get a loan that in certain circumstances they can't afford, right? And I would say that's true for most people with a loan over the course of a 3 to 5 year period. There's almost certainly going to be 1 month in that 3 or 5 year period where most people would struggle to pay that loan. And that would be on the basis of they didn't get their overtime, they didn't get a bonus, they had the boiler blow up, the car went in for an MOT, and they had loads of things to fix on it. And effectively, traditional loans just don't allow for that, right? So you're setting customers up to fail from the very start. Now, what we do is, rather than just giving you a yes or no answer, we give you a payment range. So let's say that after we do our calculations, you've got your interest rate, your normal monthly payment is £120, right? What we will do is we'll say, okay, your payment range is maybe 60 to 180, right? And what that means is that if things are going well, as we kind of expected, we would say to you, we'd message you and say, Jamie, everything's as expected. We're intending to take your normal monthly payment of £120 this month. If you want us to do something different, contact us on this number, if we look at your open banking details and we see that maybe you didn't get as much overtime this month, or you've had some additional expenditure, we might say, Jamie, things are a little bit tight this month. We're intending to take your flex payment of £60. If you want us to do something different, contact us on this number. If you use this facility, it will cost you an additional £2 in interest this month. If you have already fallen behind by using your flex payment and you have an additional affordability that month, we will notify you and say, Jamie, things look like they're going really well this month. We're intending to take your flex max payment of £180 to catch you up. If you want us to do something different, contact us on this number, and by catching up, you will save yourself £2 in interest this month, right? So it's all about understanding that a customer is going to have these ups and downs, and rather than ignore it, because quite frankly, you don't want to put that little bit more work into making a flexible loan product, a truly flexible loan product, it's putting in the effort to make sure that the loan product itself allows for that and doesn't critically effectively put the customer on a back foot, affect them in a negative way because you haven't done that little bit more work.
I think it makes a lot of sense. Generally, I'm presuming that the vast majority of people who are searching for credit online do fall into that, maybe it's an American term, but subprime category. How do you see that from your side? Are you feeling like it's just a barrage with cost of living crisis of people who probably shouldn't be taking loan products, or where are you seeing the market going in that sense?
Yeah, so I think the first thing to say is this is not a subprime product. So this is what I think would commonly be known in the industry as a near prime product. So our APRs are sitting between 11.9 and 29.9%. So essentially these are customers that wouldn't typically get a loan from their bank, i.e. prime, but actually are a fair credit risk. Right, so or at least a fair credit risk, and the very reason that we've done for or specifically targeted that sector is it is the most underserved sector you can possibly imagine. So if you can get a loan from your bank, most people just do that, right? And essentially, they're typically up to probably about 11% right now. Particularly, but prior to the interest rate increases, probably anywhere from about 3% to about 8%. And there are some lenders that specifically focus on that market as well, like a Rate Setter were typically quite low, but obviously they're owned by Metro as well, so there's a different sort of branding proposition. But yeah, typically once you went outside of that, it became very, very difficult. And for anybody that was a marginal case, like I spoke to about before, their next stop typically was, someone like 118 Money, who the last time I looked, it could have changed now, for whatever caveat you want to put on it, was typically around sort of 49.9, as an APR. And what it meant was that customers in that bracket that I'm describing often had nowhere to go. And it's a little bit of a self-fulfilling prophecy as well, because if you then give those customers loans which ultimately they are going to fail on maybe once, maybe twice or more in a 3 to 5 year period, that's only going to hurt their credit rating. So they never then get into a situation where they're going to be eligible for those bank loans. So I think realistically, our customer base will start off in that slightly higher end, or the majority of it, in terms of higher than 11.9. But what we're hoping to over time is be much more inclusive and offer, as our funding rates come down, offer more mass market loans to, effectively competing with somebody like Lloyd's Banking Group or whatever, not on price, but on flexibility. So, we hopefully would be able to at some point offer, single digits in terms of APR to our customers. Maybe it's still a little higher than Lloyd's, but they're getting all the flexibility, and they are getting, a realistic chance of improving their credit score because the loan allows for, these ups and downs. And I've heard actually from other lenders who don't use or don't have the flexible payment structure that we do, but do use open banking to a degree which I would applaud. And the data coming out of them, obviously the data that they've shared publicly, suggests that on a like for like basis, so if you had two customers that had 721, say, that essentially they are getting bad rates of 70% better than what the statistics suggest, just because they've overlaid their own scoring on that open banking data, and effectively what they're able to do is essentially identify customers that are better than their score suggests. And again, they're the customers that traditionally would have got pushed out to a much higher rate loan.
Yeah, for sure. I mean, anyone who's rented a home for 5 years and never missed a payment, that stuff's just forgotten on normal credit checks, but it's such a great indicator. You mentioned FCA regulation, so that's obviously a thing. What other sort of traction points, growth, what have you achieved really to sort of bring this pretty massive vision to life?
Yeah, so the FCA license is something that not is forgotten. People are well aware of the need for it, but I think often it's kind of a little bit lost in terms of how difficult it is. So it's actually something I'm really proud of, right? We managed to compile our application in about 3 months, submit it, and after a long licensing process, got approved with very little changes to the underlying information we sent first time round, right? So to be able to do that in 3 months with a small team, when I know lots of other lenders out there that, well, I know of one recently that's literally just given up. They had a team of 10 people, and I would say at this point they would have been going for 22 or 23 months. Wow. And the FCA had told them that you're not ready, do not submit your application. So for us to be able to run that up in 3 months with a very small team and get approved, I think is a massive, particularly given that we are doing something different to everybody else. So it actually took kind of more explanation and more documentation. We submitted over 1,000 pages of documentation for that from the work we put in that 3 months, which will tell you kind of how focused and how much we wanted to make this happen. We raised 300,000 as part of one round last June. We raised 460,000 as part of an ASA in December of last year, which is the round that we are currently in. We've had multiple trademarks approved. We've had a number of developments internally on the actual kind of process, the system, the app, all of that sort of stuff, which has meant that actually last week we managed to run through the process first time in terms of its scoring and producing a result and all that sort of stuff. Mm-hmm. I'm happy to say it passed me. That would have been a slight worry if it had declined me at that point.
And does that go on your? I mean, I know it's just a soft check, but or it's not even a check at all. It's just playing with the algorithms. But I mean, that's a massive thing. You know, it goes on your history every time you check. So does your open banking system go that way, or is it completely
Yeah.
separate from CRA?
So open banking doesn't leave any specific check or mark or anything like that. But the credit assessment does, yes. So yeah. So I got a notification said, you know, um, your credit has been checked, or you've got a soft
It's
search against this and all that sort of stuff. So
Yeah, got it. I mean, fintech's exciting. So, my next question, whilst maybe obvious, obviously I'm a funding guy, I love fundraising. Outside of just being a fintech, what was it in those funding rounds where you sort of saw that aha moment with the investors? It obviously happens. What do they really get? What did they like about this?
So, so I think the first thing to say is that most of the investors that we've had so far know me reasonably well.
Yeah,
So they've worked with me. They've seen what I do and how I do it. So when they see that idea kind of come to life, and they can see how clearly passionate I am about it and excited I am about it. What I think they probably leap to is, this guy's going to get it done,
yeah,
and the product to me is so good and so different, but actually so simple, right? Like when you think about it, most people say, so why don't people do this? Right? Why isn't this the standard loan? Right? And I honestly hope that in 5-10 years' time, it is the standard loan. That this is what everybody offers, right? Because it's one of those things that just makes so much sense. I think people really like the name. It is something that is so clear. I think people like the kind of colorways in terms of it is different, it's striking. I think it's a little bit softer than typically financial services companies come across, so there's a kind of human element to it. I think people like the customer centricity, which we talked about before, and they like some of the underlying elements as well. So we've already talked about customer centricity, but one of the ways I make sure that that's going to continue to happen is that as we develop, as we grow, we are going to make sure that our customers are reflected within our colleagues, right? So obviously I've had to run this product up. It's based on my experience of what I think a good product would be, and going back to multiple conversations when I was a debt collector about why you've missed your payment and everything I've seen in the last sort of 20 odd years. But ultimately, what I want to do is make sure that as we develop, as we change elements of our product and introduce new products, that as part of the decision making process, we will have people, our colleagues, who reflect our customers as part of that decision making process. We're also very heavily focused on financial literacy. So I spoke to you earlier about the payments, right? Part of the reason we have all of those communications is so that we increase financial literacy, so people understand what's happening and they understand the impacts. I suspect even if you had this product developed by somebody else, there probably wouldn't be as much focus around that notification process. And critically, look, you can do this, and we think it's probably the right thing for you to do, or you'll have to make a decision whether it's the right thing for you to do. But if you do it, it's going to cost you £2 more. The customer understanding that is vitally important, because how can you make a good decision if you don't have all the information? I think people like the fact that we are, doing what we said we're going to do. So as part of that, making sure our colleagues reflect our customers, we've taken on 2 placement students. And these placement students haven't gone through the traditional route, i.e. they're not doing A-levels at the moment, they're doing something called a T-level. Now, a T-level is all about technical ability as opposed to sort of academic ability. So these guys are doing app development, web development. They're doing data processing, data analytics. They're doing IT and infrastructure, right? Now, these guys are going to be really valuable to our business, and we're hoping to take them on as apprentices, right? But a lot of people said to me, well, Damien, don't do that yet. You know, wait until you're an established company. Then you can think about how to get people in. And I said, well, frankly, if I do that, there'll always be an excuse. There'll always be a reason not to do it.
Yeah.
So we went and let's just be brave. Let's do it. And it's not always easy, but we're getting real value out of these guys. So I think people, it's not one thing. Yeah. I think it's about our company ethos as a whole and about the product we currently have, and also about, the exciting element, which I haven't really spoken about before, is a lot of these rails that we're developing now can be repurposed for multiple different products. So we've got roadmap which explains internally what else we want to do with these rails. And I think there's a lot of exciting and innovative opportunities there as well.
Yeah, for sure. I mean, it's so obvious. There's very few times where you sit on calls one-on-one and 100% of the people would agree that, yeah, that's a good idea. I mean, who is going to look at a tailored loan product for consumers that desperately need credit and go, nah, that's not a thing, or that's not a product? So I think that really, solidifies it for me when I listen to it. It's like, okay, great product. Damon's obviously passionate. He's got a good roadmap, as you say. So obviously that leads me on to the next question, is with, everything that you're going through at the minute, your growth this year, fundraising on underway again. As you said, you've already raised like 700K, which is, a lot of money, especially after we've seen, big hits, Bank North. I know that was SME lending, but, that was a great company. The team there was incredible, and they've, hit the dust, and so it's great that you're getting that traction. What do you build next? Is it really that sort of, as you mentioned earlier on, like money supermarket? Is it getting plugged into all of that and seeing customers come through?
Yeah, so we're working with a number of aggregators. Won't name names, but yeah, I kind of mentioned a couple that most people would be aware of. But yeah, absolutely getting plugged into aggregators. We've got to manage that carefully, because ultimately we don't want too much traffic from day one. We want to be able to manage that, the number of applications we get, and make sure that we're on it in terms of the credit decisioning and the affordability rules. Make sure that we can constantly adapt those. And sometimes that scares people to think, oh, you haven't got it right. Well, if we were still using the stuff we've got on day one, on day 300, that's when I'd start to worry. You have to keep on top of it. You have to actually kind of make sure that you're constantly improving that area. We're obviously doing this equity raise, but we're also doing a debt raise as well. Most lenders
and that's
operate,
for your debt facility.
Yeah. So most lenders operate on a business model which is essentially, we borrow money at wholesale rates, we lend the money out at retail rates, right? So the vast majority of our lending will be funded by that route as well. We're working with other partners as well in financial services that either don't offer loans at all, or offer a different type of loan, to see if we can effectively work with them and be their kind of go-to brand, or potentially white label as well. And we want to make sure that our customers experience a great or have a great experience from day one. So we're spending a lot of time training our customer service agents on, this is custom credit, this is how we operate. Doesn't really matter if you've worked for another lender before, another bank before, this is how we treat our customers. So even silly things like, going back to the financial education piece, we obviously want to teach our customers how to use the app. So, for example, if they want to change direct debit date or change their payment date, we would want to talk them through how to do that on the app, so that next time they can do it themselves. But we don't want to just pass them off on that. Like if one of our customers says, "No, I want you to do it because I'm in a hurry," we absolutely get on and do that. But that might not be their experience having worked with other lenders. It might be, no, push them down this route because we want to kind of get rid of them. Or, even worse,
We don't have that tool.
yeah, or the IVR just kicks them out or routes them round. So we're spending a lot of time on that. So just making sure that the app and the website, anything customer facing.
Is that IVR spiral the sort of call center death spiral, as I imagine in my head? Where
Absolutely, yeah. So
Yeah.
press this number, then press another number, then press another number.
I'm just going to transfer you.
Oh, so I had one the other day, where it was a supermarket. They'd got my delivery wrong, right? And you sit on this IVR, and you have to put in your order number, which I think was maybe about 9, 10, 12 digits long, something like that. And it doesn't recognise the numbers that you're saying, so you've got to key them in. But because it's obviously always on a different part of your phone, you can't remember 12 numbers offhand. And then it asks for, postcode and the email address that is registered to it and the telephone number that's, which for me actually is different. We've got my email address on my email address on it, and we've got my wife's telephone number, so I was getting that wrong. Yeah. So I spent about 5 to 7 minutes going through this process, and then the first thing that the person said on the end of the phone was like, "Can I have your order number, please?" And I was like, "I've already given it." Either just put me straight through, and somebody can ask me for my order number, or do all that process and then make sure that when it comes through to them, they don't ask again. Don't do both. So lots of things like that where we just want to make sure before we launch fully that we've got all of the capability, all the messaging is right. We don't want to confuse a customer because the wording on the credit agreement is a little bit, ambiguous. So that's really what we're focused on at the moment, because the majority of the build, the functionality is there. It's just making sure it sings to the customer in the right way.
Got it. And last question. It's a golden egg you're going after. And, I normally talk with founders and, we all know the word unicorn. It's quite a magical word. But, you don't often sit in a conversation with something that could be a true unicorn. I mean, if you crack consumer lending in the UK to the scale you're talking prime, near prime, and in the future every other category, I mean, that is a unicorn, isn't it?
Yeah, I mean, it could well be. I mean, you look at the attributes of financial services companies that have achieved that sort of status, and I think the only thing you would say about us is, our plans show profitability much sooner than that. And we have to be careful around, the trade-off between earlier profitability and later profitability, i.e. there's a growth element where you want to be reinvesting to build and develop again. But I think we've got a kind of a really measured approach, and I think the making sure things are right for the customer. It all comes out of being cautious, right, in terms of the application of something. But we're brave with our ambition. We don't hold back on, well, let's give that a try. Yeah, let's do that. You know, we make sure we got some checks and balances in place, but we want to push on. We really want to change things, right? So I think we absolutely could be there. But our objective, more than anything else, is make sure that the fundamentals of the business work, make sure that we are true to our ethos and our mission, and all of those other things will come. You know, I heard a speech from somebody once that they talked about, you know, purpose creates profit. It shouldn't really be the other way around. And yeah, we want to remain true to that.
For sure. Well, thanks very much for the conversation. I'll end the recording there. I urge everyone to reach out to Damien and have a chat with him, and you know, go and check out what he's building. And if you've got any questions, you can ask them to me below. But thanks, Damien. That was excellent.
Cheers, Jamie.
Cheers.
Really appreciate